going to ask you for permission to
Yeah, so
record.
there you go. Well, it says recording from my end.
Yep, I
Yep.
see recording.
All right, we're good.
Okay, let's get it.
All right, so if you could just get us started, talk about the property, how you guys came across the great opportunity, the value add opportunity, and I'll let you guys take it from there.
So should I go first, Rana? Or do you want to
Yeah, yeah.
Or
Omar,
talk about if you could talk a little bit about yourselves first, please, and kind of.
well, I feel like you always already gave them quite a bit of intro. I feel like they
Okay.
want to hear more about the real stuff now, right?
Let's do it.
Yeah, I think we're good on
All right.
intros.
Okay.
So
Okay,
yes,
so
I
if
suggest
you guys
that
have
Omar
questions,
starts.
feel free to ask questions whenever as they come up.
Yeah, please do that. So can you hear me?
Yes.
Yep. So thank you, Anna. How we came across the property was basically with regards to Atlanta. We had picked out at least we'd selected certain submarkets for ourselves, because like all cities, there are there are higher income areas, less income areas, higher crime areas, less crime areas, and where we are going at least was towards more of the B and A minus sort of properties and areas. So we had picked a couple of spots. Fayetteville, where this property is located, happened to be one of those submarkets. Now, in the earlier appearance I made at Jesse and Jose's this meetup, there's actually a comment that I made there, which I said, look, when you're going to any place, and by the way, you guys are in San Antonio, so this applies equally, that you can't say when you're talking to a broker, I'm looking for a multifamily deal. Well, what does that mean? Where do you want to look for it? How big is it? What are the characteristics around it, right? So when you try to nail that little piece down, and I think Jose and Jesse can share the video of that meetup, once you have that little investment buy box down, right, then it makes conversations really easy. So because we had that down and we'd chosen certain specific submarkets, certain characteristics of properties we were looking at. So when this particular property came on board, it was like a checklist, right? Check, 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 check. That's why we decided to go for it. And oftentimes what happens is when you're choosing certain submarkets or certain types of properties, you've eventually done some level of research into that submarket, and probably you've actually even gone through that property inadvertently, either as comps or you're looking at something and this is the rent comp for that or some version of that. So that's how it checked off a few boxes. And then we decided to go forward, toured the property multiple times, and went through all of the stuff that we can discuss later. But that's basically how we picked the submarket for the city first, submarket after, type of property after, and then whether we walk.
I do feel that it's worth noting that this wasn't our third or fourth or fifth project that we looked at. That this project. So Omar and I, maybe one thing that wasn't mentioned before is that we are already partners on another property with Neil. So Grow Capitus and Boardwalk Wealth are partnered on a project in Jacksonville, Florida, and that deal closed in February, I believe. Omar.
February.
And so we had such a great experience. We're having such a great experience on that. We were like, hey, Omar, let's do this again. So Omar has been in deep acquisition mode in multiple markets since that time.
Yeah.
And not only has he underwritten like hundreds of properties, but we've also bid strategically in 3 markets. Is that right?
Yeah.
Fort Worth.
Dallas, Fort Worth, more like.
Yeah, Dallas, Fort Worth.
Fort Worth.
Yeah, it was Fort Worth, and then what was the other one? It wasn't Atlanta. Oh, Jacksonville.
Jacksonville, right?
Yeah,
Jacksonville.
and we were like in best and final, and we like lost him by a hair. I mean, it was crazy out there. There was a lot of work that went into all of those. So this is months and months of searching in 3 markets. Right, Omar?
Yeah. No,
I really feel like you can't lose that detail, that this isn't just like they don't just magically drop from the sky. It's a lot of work, and you get very far and then you lose it. And that's what happened to 2 of the deals, right?
Yeah. No, you're right. Sorry. So I didn't mention that. Look, I should have mentioned that. Look, guys, that's going to go without saying. Like, there's a lot of hard yards, like any other business in the world, like any profession in the world. If you have to get to a certain level of success, you've got to put the hard yards in. There's just no other way around it, right? So, and Anna can speak to this as well. The thing was, look, we're always in the market. Jesse knows this as well, right? So we're in the market, but what happens a lot of times is, unlike baseball, right, where if you get a strike or if you get a ball and you swing at it and it's a strike and 3 strikes you're out, in this game, you can keep waiting for the pitch forever. And as long as you don't, literally as long as you don't swing, there's no strike, right? So, we kept going at it, we kept looking at it, and but we stuck to our guns because we had a certain criteria, and that's how we got it over a period of time.
Yes. So that's how we got the deal. What was your next question, Jesse?
Yeah, go into talking about a little bit about the property, maybe some of the specs about the property, the size, that type of thing.
So do you think we should talk about the size of the property, or do you think we should just show them the promo video? What do you think would be
Go ahead. You guys, you drive.
Okay, so Anna, how about we show them?
Do they want to see some of the demographics of like the micro neighborhood demographics at all? Okay.
Sure. So how about this? How about we show them the promo, then we show them the micro demographics, because the promo isn't really that long.
Yeah, and you're talking about the property promo versus my favorite Atlanta video.
Yeah. Let's show them the drone footage, right?
Okay, let's go.
Because the one you were talking about, I really like that as well. But we're going to save that for when these people
when it's time to get up and dance.
Yeah, and when these people give us their money, then we'll show them that video. So you can see my screen, right?
Yes, we can.
Yes. Here
you go. So let me know if you can't hear the sound, then let me know.
I can hear it.
There you go. That kind of gives you a rough idea about the type of property. And now we can actually, Anna, why don't you share, if you don't mind, share your screen. We can go through some demographics and all of that.
Okay.
Georgia's like the greenest place in the world. Trees everywhere.
Oh yeah, especially when you're coming from Texas. You just can't stop raving about how many trees there are.
Yeah.
Omar and Anna, a quick question. On the drone video, it showed, for example, the park and the playground area as renovated. Just to clarify, that was already renovated when you acquired the property, or was that something?
No,
correct.
Look, part of that is renovated and part of that is broker's marketing, right? Because the broker has to market and say, oh, you can take it to the next level. So it was partially upgraded.
Okay.
So, as you know, being that we are multifamily university, we always are looking at population and job growth. So when we're putting together and looking at markets, and then also, when you guys find a market, this is in our slideshow, this is how we're showing people, this is Atlanta's employment. Lots of different colored pies. We love that. That's Jacksonville is like this too, but I think Atlanta's even more diverse. So that's definitely something we look for in a market, lots of different industries. And then here you can see the population growth in Atlanta. So city of Atlanta, which of course is, but we're in the metropolitan area, we're in the suburbs. So we also wanted to show the stellar growth in the overall metro of Atlanta. So very important things for us to look at. And of course, we had lots of demographics about lots of accolades about Atlanta, about why Atlanta is such a great city. So there's all that type of information. And then these are some of the micro neighborhood by the numbers. I believe a good number of these are from Neighborhood Scout, if any of you use that. So in this micro neighborhood, so this is like a 1 mile or actually less than 1 mile area, there's 3.41% growth in jobs in the last year for Fayetteville. That's a stunning number. Score of 86 for diversity. So this is an extremely diverse area. And that's something we look for in apartment buildings, because then you're going to have more potential tenant pool. If your diversity, if your potential diversity is a low score, that would mean that you have mostly of one kind of people, that live there. And I'm not talking about any particular type of person, but as an apartment building, you want lots of different types of people. So anyone looking at your building can look at it and say, oh, I can see myself living there. So you're increasing your pool. So 86% is a really good number. And then here's that median household income number, which I'm sure you guys talked about last week. Can anyone out there tell me what is the magic number for Neil Bawa for the median household income?
Does anyone remember?
There's a key number. There's a sweet spot area, but it needs to be something or above for us to consider it for a micro neighborhood.
40. You're right.
40 is right. 40 is right. So this was a very impressive 49.9, and the area that's just beyond this area is 71K.
So hey, sorry to interrupt. That's basically what she's saying is 71,000 is a zip code, but 49 is like right this neighborhood.
Right. And that's a super impressive number. And then here's something that we never see for apartment buildings. This area, again, this is as of Neighborhood Scout, because it rates all of the schools. This area had a 10 out of 10 for school district compared to Georgia, or a 9 out of 10 when compared to the US. So this is also a really important demographic to look for. Very unusual.
I have a story to talk about on that school district.
Uh-huh.
When I was down there doing the due diligence for this property, I decided to kind of do some market research and started going into the other properties and talking to the property managers. And I went to the nearest new construction.
Huh? Meridian. It was called the Meridian.
Yeah, the Meridian. It's the newest property near Weatherly Walk. And we got to talking to the property manager, and we found out that the property manager she works at a 2018 vintage property, but actually lives at this property. And the main driver for that was the schools. Right close to the property is the zone, the line for the different school districts or the different schools, and Weatherly Walk was on the 10 for 10 rating schools.
Yeah. So this is very unusual. It's not common to find this when you're looking for apartment buildings. This is our 11th acquisition in the last 15 months, and none of them can touch this. 10 out of 10, this is just unheard of. Property value increase of 11% between 2016 and 2017. So that's the single family houses are just screaming in value in this area. Also a super good trend that we look for. And then the submarket is expected to experience rent growth of 17%. Ding, 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 right? We're looking for rents. So this is another very key metric that really excited us about this micro neighborhood. So now I think I'll go back to Omar. And maybe I'll put this up. Here's you talk about property. Let's put this up.
Yeah, we should show this.
Go ahead, Anna.
I'm going to let you speak, Omar.
Oh, okay. Thank you. So some of the big ticket items here were, like Jesse mentioned as well. We can talk about the renovations first, but I want to talk about the rents first. As Jesse mentioned, this, and as Anna mentioned as well, this is a relatively affluent market for basically it's a relatively affluent market when you compare it to apartment markets, right? But the thing here was that what had happened is these were long-term owners. They've taken fantastic care of the property. They put a lot of money into it, but they put a lot of money into it just to maintain at that level. And because this is such a good neighborhood, it's such a fantastic school district, what was happening was that other people had come in, for instance, and basically upgraded their properties, and then they were charging a way higher rent. So one of the things you could, for instance, see is Addison on Cobblestone, the extreme left bar. This is literally across the street from Weatherly Walk. It's pretty much the same vintage, and they're charging over $100 on average. Renew at Peachtree, which is about 5, 6, maybe 10 miles away, but it's in the same roughly area. That's charging even more. So the point that I was trying to make over here is because so many stats were in this favor, we already knew that we weren't going to be pioneers. We were going to copy, for the lack of a better word, a proven business model. And that actually gave us a lot more confidence. So if you actually go back now to the other stats, Anna, if you don't mind, please.
Mm-hmm.
Right? So now knowing how much rent upside or potential rent upside we have, look, guys, there's two ways of looking at it. One way of looking at it is, wow, I can make so much more money. Another way of looking at it is, wow, I can afford to screw up and still make a lot of money.
Yeah.
Right? I mean, because you've got to realize no plan is ever going to be 100% perfect. So you've got to build in a lot of slack into your system. And when you have so much rent upside, that just goes to tell you that, well, you can afford screwing up and you'll still make money. Okay. Occupancy is 92.3. The submarket occupancy, which is all these other properties, they're more like 94, 95%. So there was some stat over there as well.
I know there was some stat. I'm looking for it somewhere. Maybe it's in our investment summary.
Yeah, maybe we speak it or something like that, right?
Yeah. So it was way higher. It was like 95%. So this is very low occupancy for this micro neighborhood.
Yeah. And then the other deal was, now I'm going to talk about the previous upgrade. So you see this $3 million in the past 4 years. What had basically happened is that the long-term owners were really good owners, actually. They held on to this property for over 25 years. And this $3 million that they had really invested, this was basically to take care of all the deferred maintenance stuff. So when you go in, or rather when we go in, there's none of this, leaky toilets and the sewers don't work and these things don't work and that, because those are things, for instance, if you go in and fix the sewer, you're not going to get extra rent because it is assumed that your sewers work. Yeah. If you go fix in wiring, it doesn't lead to a value add because people kind of assume that the wiring works, right? So you want the previous owner to have taken care of all of that, so then you and I can come in and actually put in more of the cosmetic stuff, the sexy, glamorous stuff, and then charge more rents.
So in other words, what they were calling upgrades was actually deferred maintenance, things that were wrong and were bad that they were fixing. Bad maintenance.
But you have to realize the broker is never going to call it that, right? The broker is going to call it an upgrade because they have to go out and market this property. So if you don't know these things, once you know these things, you understand when a broker says X, he means Y. When he says Y, he means Z.
And Omar and Anna, if you could, do you have an idea or a reason why, if the vacancy in the area was higher, why were they? You
mean the vacancy was lower? You mean
lower?
Yeah.
Sorry. Yeah.
Great school district. Frankly, there's not a lot of supply. Look, some of this stuff is, to be very frank with you, some of this stuff is post-desegregation, because if you look at the history of Atlanta and some of the towns in the South, what's actually happened is that as desegregation happened, a lot of folks, to be honest with you, they moved from the city to the suburbs. Now, when certain ethnic minorities move to the suburbs, those folks have to now move out. There's nothing controversial about it. I mean, this is data. This is a fact. Right? So you have cities, for instance, like Fayetteville, you have Peachtree City, which have actually created ordinances, say since the mid-80s, mid-90s, which says that multifamily buildings will not be allowed to be built, or you might build like one building every 5 years. Now, what that does is if you've got a really good school district, everybody wants to go to a school district, doesn't matter where you're from, what you do, right? When you've got limited supply and you have a lot of demand, what basically happens is that the units that you do have start filling up pretty quickly. So that's one of the reasons.
But was the question why the occupancy is lower here as opposed to the other ones? So that's, yes.
Oh, sorry. So the reason for that is straight up that the owner has owned this property for 25 years. They have capped out all of their depreciation benefits. They have literally refinanced this property 2 or 3 times and made a boatload of money on it. They had no incentive to throw more people on this property, spend more resources out of their property management firm just to get the occupancy up by a couple of percentage points, because that would not result in, it's going to be meaningless to their end results.
For them.
Yeah, for them. For them it is.
For them. But to us, it's a value add because we know that this occupancy is low for the area. And we have our efficiency center team to help us. Besides the property manager, we're not going to just leave it to the property manager. We're bringing in our team, our virtual army, to help us fill up the property and then keep the property filled up. So this is our Filipino team that does all of these various things for us. So so we're not going to fall into the same trap of this. I mean, not that we would, but we have extra processes and systems and manpower in place to make sure that we can take advantage of what this market is capable of delivering.
Excellent. And guys, if you get to look for more information about Grow Capitus and Neil and Anna and their strategies on the marketing side, it's amazing how they take advantage of every single opportunity to attract tenants and how to reel them in from just the first touch all the way up to showing units.
Yep.
Just the way they do it, it's amazing, and they don't leave any rock unturned.
Here is amenities. You guys kind of saw the walkthrough of it. Omar, you want to talk about the business plan?
Yeah, we can talk about the business plan. So the business plan for us, as I mentioned, was basically a lot of this, I'll be honest with you, is sexy, glamorous stuff, right? So for instance, when we get to, say, an interior unit, we're going to put in faux granite, and in some cases, granite countertops. That just oozes sex appeal, relatively speaking, right? We come in, we have two-tone paints, we take away all these dingy white-looking tiles that are just kind of gross. We put nice stuff in. And basically the idea here on the interior is to strategically renovate the interiors up to 70% of the units. We're spending between $700, it says $700 over there, between $700 and $900,000. The renovation should roughly take between 18 to 20 months. On the common areas, a lot of this is, you saw the lush foliage, right? So taking advantage of that, doing a lot of landscaping, but leaving a lot of things untouched because it does really look nice. We're going to put an Amazon locker. Now that's a win-win for everyone. The reason why it's a win-win is the property manager's got to do less work. So now they're able to focus more on the actual management of the property. It's a win-win for the tenant because they don't have to wait for the leasing office to be open. They can go in at, say, 2 a.m. at night, right? Punch in their code, they got their package. When we're also going to, the new monument basically means, because we're rebranding the property, it was earlier known as Weatherly Walk. We're now calling it Equinox at Night. You know, it's a more hip kind of brand. So that's a new monument. And the rebrand and improve operations, which is the fuchsia color over here, you can see Efficiency Center is what we were just talking about. That is the Grow Capitus Efficiency Center, where we're basically complementing the marketing and increasing the leasing velocity at these properties. Alexander Properties is our property management team. And the exit strategy, really, like a lot of value add strategies, is potential to refinance in 2 to 4 years with disposition in 3 to 5.
So let's talk a little bit, since we're talking about exits, let's talk a little bit about the financial highlights, especially the loans.
So do you want me to go about it, or do you want to go about it?
Yes, man. I love hearing you talk about debt.
Before we get there, Omar and Anna, is everyone okay to this point? Anybody has any question? Please.
And please ask questions. Okay? Yeah. Please actually ask questions. Don't wait.
Yeah, this is a completely open forum, guys. So feel free to ask. All right, go ahead.
Cool. So do you want to go back? Yeah.
Yeah. So let me just tell you where I was thinking of going with this, Omar and Jesse and all. So I was thinking we'd give kind of the highlights of the financials, and then just an intro to what the projected returns in percentages and money, and then go into the spreadsheet, right?
Sure. Yeah.
So we're kind of easing into Excel.
Sure.
Here we go.
So look, the project returns are 1.9x equity multiple. What that basically means is that for every dollar you give us over the course of the holding period, right, which we projected is up to 5 years, we'll give you $1.90 back. So $1.90 back. Essentially what this means is that if you include all the cash on cash returns plus the returns that you'll make on exit, which is upon sale, 1.9x is a multiple. So for every $1 you give us, you get $1.90 back.
Which includes your original dollar.
Which includes your original dollar, obviously, right? Skin in the game, basically, guys, is very important because essentially, for the lack of a better term, you don't want to be involved with people who don't invest any of their own money, because the issue there becomes that it's a case of heads I win, tails you lose. Heads I win in the sense that if this property performs well, you think I'm a genius, I definitely think I'm a genius, and everybody is really happy. But you've got to realize what happens if the property doesn't perform. So the sponsor has got to feel some level of pain right? So they don't just check out of the properties and performing. So we put in $300,000 from our own pockets just to show you, our interests are aligned with the investors. On the loans aspect of things, we've got a bridge loan. There's a couple of reasons for that, but the biggest reason from my side at least is that if we're going to dispose of this property or at least refinance or finish the value add process within 2 years' time, getting an agency loan is completely asinine. I mean, and the reason why it's asinine is...
Can you say that here?
Sorry, what? Asinine, right? Yeah, it's not a bad word. It's more than once. It's more than one syllable.
Yeah, as long as you don't cut the word in half.
Okay,
yeah.
All right.
Yeah, I mean... as long as definitely you don't cut the word. Look, it's and I'm going to say asinine again. It's asinine because we're going to do all this hard work, right? So we increase the NOI, we've done all these renovations, but if you've got an agency loan, and then you want to go, say, in 2 or 3 years' time to either sell it or refinance it, you get charged massive prepayment penalties. Right.
So just an agency loan in this case, for some of you that may not be as familiar with the term, we're talking about Freddie Mac, Fannie Mae type debt that tends to be a 10-year. It can be a 7-year, but the average is 10-year. It can be as long as a 12-year. And by locking in those long terms, they will give you those, always lower interest rates. And in today's terms, the interest rates are just astounding that are being offered by Fannie and Freddie. However, that's like a black widow laying their trap, because if you're trying to do value add, as Omar is describing, it does not work for you. So just had to throw that in there to expand on agency.
Yeah, but look, the flip side to this is, if you're, for instance, buying a property by yourself, as in you and your family are buying the property, so there is no external pressures, you want to hold on to this property for, pass on to your kids and something, then by all means go ahead and get an agency loan, because you're going to be in this for the long haul. But contrary to what pretty much any sponsor, any multifamily sponsor will tell you, we all make our money upon sale. Essentially, we make like 80 to 90% of our money upon sale. So what's actually going to happen on the ground is that a sponsor is going to do all this hard work, and then they want to sell and get the money. So if they force you to get into an agency debt, the problem is going to be all the prepayment penalty or the penalty that the lender charges you. That's not coming out of the sponsor's pocket. That's coming out of your pocket as a
Yeah, that comes out of the profit. Yeah.
Yeah. So you will be affected. The sponsor will not be affected. So just some things to keep in mind. The loan, by the way, over here, the interest rate, which it says 4.8%, we were really conservative on it.
Yeah.
Actually, the interest rate we ended up getting was 4.51%, actually.
Yikes.
So,
wow.
I mean, to be honest with you guys, that's like somebody giving you free money.
That's ridiculous.
Right.
And the general thought, a lot of people said for bridge loans, they say, well, bridge loans are risky because it's not fixed for such a long time. So what if the interest rates go up? But the general...
And what if the market turns too? So can you touch on that?
So what happens?
So what happens when the market turns? Yeah. So what happens when the market turns? So what happens if we do go into recession? What happens to interest rates? Do they go up or do they go down?
Take a wild guess, guys. Because I've literally...
Down. Everyone's saying down.
They go down. So what is our risk in the next 3 to 4 year time frame of interest rates going up? Very low.
Relatively speaking, right? It's a probability game. Nobody knows.
It's a probability game. Exactly. So if many people are saying, hey, there's a recession coming, well, that doesn't mean, why would we want to lock into agency debt at current interest rates then and try and, sometimes you lock into agency debt, you say, well, somebody will assume it. I'm going to sell it to somebody else. They'll just assume my loan. No one's going to want to assume a loan that's, half a point higher than what they can get.
Well, actually, this is happening right now. I'm looking at a few deals in Atlanta.
Yeah.
And some of the problems are that there are guys who want to sell their assets. They want whoever's buying to assume the debt. And that debt is at 4.8%. Now, look, I'm going to be honest with you. 4.8% in any other time in mankind's history on these types of assets would be considered a steal.
Yeah, absolutely.
I was like, dude, help me out here. I literally got a loan 2 weeks ago, and that's 30 basis points lower than this. And I don't even have to go through all this paperwork of assuming and doing this and that. So just keep that in mind, because a lot of times people are concerned and say, well, I'm concerned about a recession and interest rates going up. I was like, dude, you can only have one or the other.
Yeah, it's not going to happen.
If it's a recession, the Fed isn't going to dig a deeper hole. And look, if it's a boom time, you're not going to have a problem selling the property. Okay? It's not, that's not going to be your problem.
Yeah.
So just giving you some context around, when a lot of times people hear things and we repeat things without necessarily realizing that they don't necessarily make sense. And when you step back and actually think about it, then you actually realize, oh, a lot of things that people assume are common sense are neither common and they're nonsensical.
Now, there's also another thing out there which people talk about with a recession, which is not just interest rates, but they talk about what happens if the cap rates start going up. So that is definitely something that happened in the last recession. However, interestingly enough, we are seeing interest rates going down for the past year or so, and cap rates have continued to go down with it. So we no longer have this situation where interest rates are going down, and the relationship it's changing. So as if we have a recession, there's no longer this tight coupling between cap rates and the market, because there's so much money out there in other countries that can't get nearly the amount of interest rates that they can get. They have negative interest rates going on in their countries. So there's money pouring into the United States. And where are they going to put it? Many of those people are looking at multifamily. And because of that, that's keeping our cap rates low. So that is the other element that can happen in a recession, is cap rates can start to go up. But many people think that cap rates are going to stay, maybe they go up a little bit. Many people think they're going to continue to go down.
And just to let you know, guys, you don't want to be in a really high cap rate market also, because that probably means you're going to get stabbed and have one of your kidneys stolen when you go visit the property. So, keep that in mind also. The higher cap rates doesn't necessarily mean a better quality product or a better deal or whatever you want to call it.
Yeah.
So, and the total equity raise was about $7 million. And by the way, we raised that in about 2.5 days or 3 days, whatever it was. So that just goes to show you, A, the quality of the product, the quality of the team, and then the quality of the offering. Anna, do you want to take this?
Sure. So we'll show you the underwriting next, but just to give you an eyeball full of what the projected returns are. These are cash on cash returns. So there's an 8 pref for this. So the investors are getting an 8% preferred return. So they've got 8% year 1, year 2, year 3, it starts to go up where they've got 9.3%. And then notice it goes down here. So that's a bit funny, right? What's happening here? Well, what's happened is this is year 3, and our bridge loan, should we keep it past here, the interest rates have changed. So we've gone through 3 years of the bridge loan, and then this is the extension, correct, Omar?
Yeah, and this is actually where the interest only period goes away.
Yes, right? So the interest only, so it's both. So the interest only period goes away, and we're going into an extension of a 1-year loan and then an extension of a 1-year loan. So that's why we have this switch. But you can see all in all, that's not an extremely dramatic change. It's almost a point, but it's less than I'm used to seeing, actually, the difference between when IO stops.
Yeah, and guys, by the way, this is just on that point about the bridge and how quickly all syndicators, including ourselves, want to get out. You got to realize our business plan, you see how by business plan, I mean the renovation plan was between 18 months to say maybe 2 years at most, right? So after this, around say the 16, 18 month mark, if you're actually executing on your business plan, most syndicators have their hair on fire, either trying to refinance a property or to sell it because they've done the bulk of the heavy lifting. Right. So when they sell it to somebody, the idea is that that person is looking more for a turnkey solution, a stabilized property. Whereas we, for instance, have to spend hours and hours and hours every week making sure that we don't leave any rock unturned. Right. So it's a different type of buyer, buying a different type of property. But that's why you see, because we're trying to get out in 2 or 3 years, this gives us a lot of ample room. This gives us a lot of runway in case we're not able to execute on a business plan. We still got 3 years to go do something.
And
can you explain the extensions, the 2 extra years? Can you explain that a little bit?
Omar can take that one in just a sec because he was, but what I wanted to say, when we're talking about the business plan and getting out early, we're not just talking about cutting off our nose here. By executing the business plan, we're talking about reaching our end goal that we had promised, projected to investors much earlier than anticipated. So that is when we're like, we've already met our business plan. So now it's time to exit. So we're not just stopping here and saying, let's get out early. So I wanted to clarify that for people, that it is about reaching the projected business plan, hopefully in an earlier time frame than we speculated to investors.
Yeah, and look, at the end of the day, what you also want is comfort to know that in case things don't work out, because sometimes things don't or can't or won't, you just have enough time, right? Because you've got to realize a lot of times when you are, or anybody is put under undue pressure, people tend to take stupid decisions, right? When your back is against the wall and you just got to do something. So you never want to put yourself in that situation. You always want to be well capitalized. You always want to have enough time. So you're able to take decisions calmly, coolly, without any pressures. That's also a big reason.
So Omar, here's the loan information again, just to talk about the 3 years plus 1 year plus 1 year.
So basically, guys, over here, what basically happens is that because it's a 3 + 1 + 1, the +1 + 1, what it really means is that we have to hit certain objectives or certain, say, key metrics that the lender actually asks us to get. So for instance, on this, I think we have to hit a 7% debt yield when we're trying to do the first extension, which is years 3 to 4, and an 8% debt yield from years 4 to 5. That basically means that our performance has to follow certain paths, which is really going upwards trending, because otherwise the lender is not going to basically give us the extension on the loan.
Yep. So we've got to perform.
Yep. Yeah. So it's a pay for play sort of deal, right? You perform, you play. If you don't perform, you're cut out of the game. And you actually want that. You want sponsors to feel that heat, because if they don't feel the heat, look, as an example, if they don't have skin in the game, they don't feel the heat. If things work, it's all good. But if it doesn't work, they're just going to check out and then your money's gone.
Yep. So here's that same slide that had the percentages as if you had $100,000 invested. This is always a very good example for some people that they just read it better this way. They like seeing dollar signs. So we always like to show dollar signs. And in this case, this end one, of course, does not include the original 100,000 invested. So remember, Omar was talking about if you give us $1, we give you back 1.9. Well, here's that 0.9 that is your profit. That is that 1.9x equity multiple. This is what it looks like in dollars. And then we're just about to go to the 1031, sorry, the Excel spreadsheet. But I will say that this property was an example of a 1031 eligible project where we had our normal investor entity, which in this case was a limited partnership, an LP. And then we also added on a tenant in common structure to bring in some 1031 investors. And this is a vehicle that we are doing for various properties where it makes sense. It has no impact.
Could you very quickly explain 1031 for the new people that are not familiar with the term?
Sure. So a 1031 is the ability to defer your taxable gains or your taxable, what you'd be taxed on for your capital gains by taking a property that is an investment. It has to be an investment property, not your primary household. And instead of selling it and paying taxes on it, you sell it and then you put that money into a holdership, a 1031 exchange company, and replace it with another property. You can never touch the money. It has to go into this account by the 1031 exchange people and then go into the replacement property. If you do it all right, and it's got very specific timelines associated with it, then you do not have to pay any capital gains on the transaction. So the money goes from one property to the other without paying taxes. Now, it is a tax deferral. It's not tax-free. So
it can be tax-free if you die.
If you die.
Yeah.
It's tax-free to your heirs.
Yeah.
But let's assume this person doesn't die. If that person were to sell the second property, and not do a 1031, then they would owe all the taxes from the first property and the second property gain. So if you're doing a 1031, you want to do, that's the strategy in my family, is that we're like 1031. We love it. I've already done 7 1031s, all of my siblings as well. So if your strategy is to do 1031s, you ideally want to hold on to it through your entire life and pass those assets onto your heirs, your children, whoever your heirs are. Because when that happens upon your death, there's a step up in basis where that property is now stepped up into the current value, and there's no taxes owed by your heirs on that.
On the previous gains, it
all goes away. So
yeah, but their clock starts. Yeah,
so their clock starts. So then they can sell it at market value right then on that day and take that profit, and they're good. So.
All right, thank you so much.
So Omar, I'm going to stop sharing, and you can put up your Excel spreadsheet, please.
Hold on.
All right, real quick. The models and the financials and all that they share are not going to be dispersed. So this is a proprietary.
That's a difficult word, I know, Jesse.
Yeah, proprietary model, and the T12 and rent rolls are confidential because, when you go to a broker and you get that information, you always have to sign a confidentiality agreement. And so as such did we. It's got tenant data on it. It's real data that's in there. It's not fake.
Okay, so give me 1 second.
Now, those numbers that I was showing on the slide deck were not the updated numbers with the interest rate as it closed. So the projected returns are probably even better, right, Omar?
Yeah, I mean, they're different in the sense
they're different.
Yeah,
so
certain things keep changing. So
yeah, and that's one thing that while he's pulling that up, that is one thing to know about underwriting. That we do kind of draw a line in the sand and say this is the final underwriting we're using for to show to investors, and it's the best we can get. But it does continue to change. Interest rates change. This changes, that changes. So it is an iterative process. Underwriting is so.
Yeah. So you guys can see that screen? Everybody can see that?
Yes.
Yeah.
Cool. So how do you want to start this? Like, what specifically do you guys want to talk about? Maybe we can structure it whatever way you want to structure it.
Well,
basically, no, I mean, I think you pretty much show the returns and how it look. I don't know if anyone would have any specific question about the underwriting itself, or
how about if we look at the expenses, Omar? Because that's we haven't talked about that yet. Like on the pro forma, looking at the T12 and then working with the property management to come up with our model.
So do you want to talk about our projections, or do you want to look at the T12? Okay, we can look at the T12.
Well, just how the T12 translates.
Yeah,
into
if you don't mind,
underwriting.
we can tie it with one of the questions that we have is, what are there any challenges what are challenges that you found with this property? Maybe something that you found on the T12, or things that are opportunities to work with, or challenges.
Okay, so one of the challenges was, well, it's not really a challenge. It's an opportunity and a challenge. It depends how you look at it. So the challenge / opportunity was the payroll number, or it was something that we really had to work on and work with. The other thing, I think a lot of folks, which for whatever reason they didn't realize or they didn't really take into account, is that the property management percentage, if you look at it this way, so let me just show you. So I'll take the property management number divided by the total revenue. I just want to illustrate a point, so I'll show you something. Right, so if you look at it, you'll see that it's 6%. Can you see my screen?
Yes.
It's huge.
Right, so it's 6%. Now you would think, okay, wow, that's really weird. What's going on? Are these owners stupid, or what's going on? And that's not really the case. The case is that the existing owners, which I've told you have held on to this property for a long time, they also happen to have a property management firm. So the reason why they can charge more money to their property is because they have a property management firm and they happen to own the money as well. They own the property as well. So they can, it's a lot of accounting stuff. I don't want to bore you to death, but basically this is a way to move money from one entity to the other. So that's why you see such a high number, but we obviously don't have it at 6.6%. We have it way lower. So just to give you an idea, that was an opportunity right off the bat that we saw, that we could come in and cut property management fees pretty much by half or 45%. And that's going to be a big saving, right? So that's one opportunity slash risk. I mean, the risk is that you might try it and find out, oh my God, this property really needs a lot of work, right? So we did a lot of due diligence and figured out it wasn't necessarily a property issue. It's more of the case of an owner just deciding to charge his other company, which he happens to own, more money than he should be, than in the open market. The other thing over here, which I'm actually really liking, is the fact that we have no rubs. I love the fact that we have no rubs. And now you would think, well, why wouldn't you want to have rubs? Because rubs, it means you can, for all the utilities you consume, you can bill back to your tenants a certain percentage or certain dollar value. Now, the reason why this has no rubs or no utility bill backs is because all of the units are individually metered. So all of the tenants, they pay 100% of their own bills. Typically what happens is you try and you try and you try and you try, and the most you can get people to give is 75% of their bills, right? Because properties are master meter, right? They have just one meter. So in this particular case, the tenants take care of their own bills, which basically means that extra 20 to 25%, which we had to eat ourselves, we're not eating that. The tenant pays their own bills. That's another big thing, by the way, on the property from an operational perspective as well, because you can imagine that when a new management comes in and they jack up the RUBS rate to basically say, hey, you now have to give me more money for the utilities you consume, that really, lack of a better term, it really pisses people off, right? So we never really even had to get into that. The property management was a big thing. The other thing which we realized over here was that a lot of basically the costs that the sponsor had already, the previous owner had already done, they were also in the process of still incurring a lot of cost. All the things they were putting, instead of capitalizing them, they were expensing a lot of things. Now, what does that do? What that does is that it artificially lowers your NOI for no reason. It's just an accounting thing. It shouldn't be happening that way, but it was happening that way. So that was something that we really picked up very quickly. Payroll was the other. What else was there?
Well, I feel like you're going a little bit fast for some people. Mm-hmm. So I just want to clarify that the repairs and maintenance, by putting in capital expenditures, those are things that you can put into your CapEx account, which is below the net operating income line. So it doesn't affect your NOI. And your NOI does what? Your NOI divided by the cap rate determines the value of your building, right? So you're always trying to protect your net operating income and be careful about what's counting against it. Well, in this case, this owner I can't even imagine why they were doing it, Omar.
Look, it happens from time to time, especially if you've owned a property, you made your money 5 times over on a property.
They weren't that concerned about it. But Omar is accurate that it presents an opportunity for us because they were putting things into the wrong bucket. Yes, it was the repair, but it was a repair that should have been put into the CapEx area and thus not impacted the net operating income of the property.
Yep. Some of the other
things.
Yeah, go ahead.
To clarify, CapEx is capital expenditure, so basically
Correct.
You can depreciate that
right.
those expenses versus
and it lives in a different part of your profit and loss statement. So.
Yep. And the other, some potential wins that we can implement over a period of time are valet trash across all the units, washer and dryers on more than 100 units, because this tenant base can afford that extra expenditure, right? And they would like it because, look, they were living in a good school district. It's a very family-oriented community. In fact, when we were there in the afternoon, because we were doing our due diligence and stuff, there was a stream of kids with backpacks. You know, when the bus drops you off at a certain time, there's like back-to-back, grade 2, grade 3, grade 4, grade 5. I mean, kids were just streaming back. So, typically what happens is when you've got kids, you've got a lot of dirty clothes, and everybody hates lugging their laundry down to like a laundromat. So people will gladly pay $50 or $55 for a washer and dryer. So
and the washer dryer hookups are already in the unit.
Already there.
Yeah, the washer dryer hookups are there. And these units are very nice size for family, by the way. So that is one important thing when you're looking at an apartment building. We talked about how good the schools were. Well, if this apartment building was a bunch of studios and small one bedrooms, it wouldn't be relevant that the school district is so good. But this specific building is very desirable for families because of the size of the unit and the low crime, as well as the school districts.
Of course. So again, those are some of the big things. What were some of the challenges, Anna, you felt? Like one was the 1031, right? But that's more of an administrative challenge. It wasn't really a challenge. It was
a challenge with a lender related to the 1031. But the lender certainly took a while to close. So the lender was a challenge, but we got through it.
Yeah.
I think that the whole, I think maybe you should give them a little bit of the story of the property management and how you got the deal, whereas other people didn't.
So in our particular case, how we got the deal is that we are retaining the existing property management firm. And how that happened is that one of the questions I asked the broker and then one of the owners indirectly at the start at least was, well, what's your big incentive for selling the property? And what are you looking to do next? Because look, you're going to get a nice amount of money. What are you really looking to do next? And the guy straight up told me, he said, look, I mean, I was young once, I was your age once. I've been doing this stuff for 40 years, but now I'm at a very different stage in my life, and acquisitions is a young man's game, right? Because you've got to go out there, you've got to meet people, you've got to pound the pavement. So he's got a property management group that manages over 5,000 properties in 5,000 units in 5 states. And he said he was looking to transition and keep most of the property management because that is a more stable business, right? That's hey, you come to the office every day, you do your job, and you clock out at a certain time sort of thing, right? Whereas at acquisitions, what happens is when a deal is live, you get no sleep. And so it's feast or famine, right? Whereas property management is more like steady Eddie sort of a business. So they were looking to transition more over there. More than that, what was also happening was that they were looking to try to work with the group and keep that property management there. We interviewed them, we liked them to begin with, but when we really knew that this little factor was in play, and that was really the deciding, sort of in a way, a mental block or a mental deciding factor, we really played up on that. Right. I made it a point to go talk to the owner personally, follow up on personal calls. That doesn't always happen. The owner started telling me, because I went to school in Toronto, the owner started telling me, he'd been to Toronto a few years ago. His son basically loved the medieval times there. I don't know if you've been to medieval times. It's nice if you're really drunk. It's a great place. Otherwise, it's kind of dumb. But they really enjoyed it, right? And you start developing that rapport. That's what I'm trying to say, right? But you can only really develop that rapport when you really understand what does the other party is really looking for. Because if you don't know what they're looking for, how can you position yourself to stand out from the crowd? Then you're just like any other person. So One of the comments they actually said was, look, there were a lot of out-of-state buyers. There were a lot of buyers who were within Atlanta as well. But nobody took the time to really talk to us and kind of get our feel. And there were a few people who were paying a little bit more money as well. But we were able to get the deal because we developed a personal relationship. Now, obviously,
and we were keeping the property management because none of the other people were willing to do that.
Yeah.
What is the risk for us if the property management doesn't work out?
Well, the risk for us if the property management doesn't work out is that we'll have to transition property managers. So for the next 1 or 2 or 3 months, as an example, there's a transition period. But you also have to realize with these companies that are managing 5, 10, 15,000 units, this isn't a fly-by-night operator.
No. It's not. They are very experienced. But I'm just saying, for us to give up on that, for us to understand that was a big deal to them, and for us to say, it's really not that big of a deal if we keep this property management. We're an experienced group that knows how to change property managers. We understand how to do that transition. So it didn't scare us. And I think some of the other people were like, no, we're absolutely not going to keep your property management. Absolutely not. Whereas we're like, what the heck? Sure, we'll keep your property management,
There's also, by the way, a strategic reason. Apart from all of this, apart from things related to the deal, the other reason also is you've got to realize, guys, this is still very much a local game. It's because look, as an example, there are folks who are, say, managing $800 million of assets in Texas, but frankly, nobody's heard of them in Atlanta. Or there's groups in Florida that are managing $2 billion of assets, and nobody's even heard of them in Georgia, right? Because it's still a very local driven game, still, contrary to what you hear. Local relationships matter a lot. So when you're working with people that have been in a market, like say Dallas and Atlanta, Houston, Miami, Jacksonville, and Orlando for 40 plus years, they also have a lot of local relationships. So it's not just one deal you're looking at over the runway of your relationship. So deals 2, 3, 4, 5, a lot of times they're able to open doors. They might take you to the mayor's office as an example, or the city, or they might be able to pull permits quicker, right? Whereas the other guy's going to take them forever, right? So you've got to realize those things, those relationships. You're not just getting a property manager, you're getting the sum total years of experience of that property manager's relationship in a local market. And in a lot of these markets, you can't buy that. Frankly, you can keep paying more money and you're not going to get anywhere. So you also have to remember that as a strategic. Relationships are still very important, especially in the South. So you always have to keep that in mind as well. It's transactional, but not as transactional as you would think it is.
I would like you to jump into rent comps. I think that's a subject that gets left off a lot, and you can just jump in here and show and talk about how you got. Where did you get your rent comps from, Omar?
So there's 2 locations, right? So let's assume the first time around, when you basically, when the broker sends you the OM, right? I mean, you've got nothing, all you got is an email and you download the OM. So here you go. So let's run through a quick exercise and we can show you what happens, right? So let's assume I know nothing about this property. I just have the broker's OM and I read through the offering memorandum. I read that. But like all cynical people, I'm not going to believe what the guy says, right? So I will
never believe what they say.
Never, right? So I will literally show you the 5-minute way on how to find a lot of these things. You know what? Secret is going to Google. That's the secret. You don't need anything else. You literally type Weatherly Walk Apartments, Fayetteville, GA, Georgia, right? Here you go. I type this.
We can't. We're seeing the Excel spreadsheet.
Oh, okay. Hold on. Oh man, all that little dramatic pause I took between.
I know.
Hold on. Now you see, I'm going to say this again. Okay.
Okay.
So you go to Google. So all you type is Weatherly Walk Apartments. You can see my screen now, right?
Yes.
Fayetteville, Georgia. Right. Now, what does this do? First of all, I confirm it's the right address because you don't want to start doing work for the wrong property. I just open up Google Maps. Number 1, go here. Click on Google Maps. Now it basically tells me where it is. But the other thing I also want to do is I want to open up apartments.com. Mm-hmm. And then what I want to do is go over here. So I kind of want to zoom in a little bit. And where the heck is this, right? So what I kind of want to do is zoom in. I think I zoomed in too much. And I want to see what are some other apartment buildings around it. Because I just want to do a quick and dirty 5-10 minute thing. So I see there's Weatherly Walk Apartment Homes right here, Swanbrook right here, and Addison on Cobblestone right here. I did look at Swanbrook. It turns out this is a government subsidized housing for senior residents as well. So obviously that's not a comparable, right? So the next one was Addison on Cobblestone. So what do? I go to Google again. I type Addison on Cobblestone. And by the way, all of this stuff is free. So, this isn't some like magic trick that I only know of. Right? So what do? I do the same thing. I can open up their website, right? Because that'll give me like the latest rent numbers. But what I can also do is open up apartments.com. Now I can go through all this stuff, but really starting off, what I really want to do is look at the pictures. Because what I kind of want to get an idea is, well, how do these properties look? So I look at Addison, right? I go through all these pictures one by one. I see, I mean, it doesn't look too bad. I think it kind of looks nice.
I think it looks nice.
I think it looked very nice, right?
Maybe you should make an offer.
Yeah, the problem is they already have had a change of ownership 1 or 2 years ago. That's why it looks really nice. But what I do now is I go to Weatherly Walk, which is the competitor or the comp, but the one that we're really interested in. And I start comparing the pictures. And what do I see? It looks nice. But as you can see, it doesn't look as cool as this property looks. You see how the lighting is nice, the paint is fresher, the finishes are nicer. Yeah, so as you can see, I mean, nothing looks off if you think about it, right? This doesn't look off. It just looks a little outdated, right? Yes. So now that gives me certain things. Now, the other thing I can do is, how do I exit out of this? And again, guys, this is just the 5 or 7 minute analysis, right? Because what you don't want to do is chase your tail for 2 hours and then figure out, oh, this is not making any sense, right? So I kind of get an idea. Okay, the 1 bedrooms are 925, 3 bedrooms are 1325. Quick and dirty right now, right? I go to Addison's website over here. It says floor plans, right? So I'm going to click on it.
It says call for pricing.
Oh, no. It used to have the pricing over here. Actually, I don't know why. I think they must have changed it. So I can go to apartments.com. It used to have the pricing over here.
It still say call for pricing on apartments.com too.
Will it? Does it? Oh, that's not cool because it used to have the pricing over here and all of these prices were like between $150 and $300 higher, right? So you can, but hey, you know what you can do? Save yourself the hassle, literally call for pricing.
Yeah.
How long do you think is it going to take? And when you call, do you think they're not going to give you the price? They want to give you the price. They want to rent an apartment, right?
Yeah.
So that's basically the quick 5 or 7 minute quick and dirty. You don't got to do a lot of, for instance, analysis. You don't have to do underwriting. You don't have to kill yourself in the process because if there is no rent upside, as an example, right? What are you going to do? You can't do anything.
Right. And if the apartments already are fully renovated. Now, here's the thing. Sometimes you're going to go onto apartments.com and you're going to see the apartment looks really nice. And you're like, oh, it's already renovated. But you can go back to the broker or go back to the offering memorandum or the broker. Maybe there's only 10 units that they've renovated like that. And that's the model that was then photographed for, for the apartments.com and for the offering memorandum. But the 90% of the units or even more are not renovated. They were just proving a point that they could, what could happen. So you do always want to ask how many units are renovated if you see that it's renovated.
And this is, by the way, the property that Jesse visited, the Meridian at Lafayette. This was built in 2016. Now, obviously, you can see it does look nicer. But one of the things that I want to show you is that it's going to tell you what is, say, $1,200 to $1,380, right? This basically means it's more $1,380 than $1,200 for rent. But one of the things that I wanted to show you is that it tells you what is the ceiling of rents for, say, in this market. So, for instance, if Weatherly Walk is whatever it is, $925 right now, right? And the Meridian, geez, where did that go? The Meridian at Lafayette is $1,380. Now that tells you that $1,380 is a theoretical limit, upward ceiling in this market for a 1 bedroom, because that's the newest, nicest property. So then you know that your answer, if you renovate, is somewhere in the middle.
And what's the square foot comparison between the two?
Oh, this probably is going to be like one is 786 and one is 720.
So they're not that far apart. Yeah,
it's not that far apart.
Yeah. But you do want to take notice of the square footage. You don't want to compare things that are too far apart.
Yeah, but you also have to realize that once you understand what is the limit, what is the ceiling, and then when you realize where are you, then you understand, because look, you obviously also have to use some common sense, right? Because you can't price it $50 below the new build, because people will be like, dude, I'll just pay the $50 and move to a newer build. But that gives you a relative point of reference. And that's all you're really trying to do in the first 5 or 10 minutes. Because once you start getting deals, what you'll realize is you're getting, say, 20 deals a week or 30 deals supposedly a week. You can't spend 2 hours doing everything, man. You're going to go crazy.
So this apartments.com, why do you trust their data so much, Omar?
Well, it's not necessarily whether I trust their data or not. Number one, the issue is everybody else also looks at the same data source. So number one, if we're wrong, we're all wrong, and we're all looking at the same reference point, number one. So our relative referencing is the same. But from a not so cynical point of view, apartments.com is owned by CoStar. CoStar is the biggest database company or industry database within the multifamily industry. So you know that on average, there you always have to do your due diligence, but on average, they have the freshest data coming through the system. So that's another big reason.
Yep. And they actually call owners of multifamily on a regular basis to check what the rent is. So this isn't just data that they scraped, 3 years ago. This tends to be more the current data that you can find out there.
Yeah.
For free. All you have to do is go there. It's free for you. CoStar costs $1 gazillion, but apartments.com is free.
And guys, this is just step one, okay? We're not
Yep.
saying don't do all the other steps. This is just for you to get some context at the start, whether there's enough meat on the bone here for you to go even chase this. Once you do decide to chase it, then steps 2, 3, 4, 5 come into play. But why go there if step 1 doesn't work?
So what about things like rent growth and expense growth and stuff like that? How do you, assumptions. So talk about your assumptions in your underwriting.
So as you can see over here, we talked that 17% was the expected assumption, so expected rent growth over the next 5 years. So we are coming in at lower than that, 15.5. Now, part of the reason here is that in the first year, the reason why we have higher growth, especially in the first 1 and 2 years, is we're doing a lot of heavy lifting in the first 1 or 2 years, right? But we all know that the further out our forecasting goes, the more conservative we have to become because,
right,
there's just more things that could happen, right? So that's why typically you see pretty much everybody's rent growth is kind of the same thing. It goes up the first 1 or 2 years and then goes down. And or rather, that's the way it should be, right? Because the further out you go, the less points of reference you have. So therefore, you should bake in a lot of conservatism into your numbers. And to be honest with you guys, the inflation rate is more than 2%. So even if you're just growing at the rate of inflation, 2.5%, 2%, that's a reasonable assumption to make.
Yeah.
So should we go down to the rest of the stuff?
Sure. You've got other assumptions, which is one of the things I love about this particular model. The ability to tweak all the different assumptions is not something you find on a lot of models. And I love that this is a feature.
So basically the rest of the assumptions are around loss to lease, which basically what it means is loss to lease means, look, potentially or theoretically, the market rent, say, might be $1,000, right? As an example, theoretically speaking. But let's assume somebody comes through the door and you want to lease it out. And the most, again, we're just going through an example. You lease it out at $980 as an example, for whatever reason, right? So the $20 is the loss to lease, because what it basically means is that if you had just waited for the right candidate, you could have potentially gotten more money. But we all know in reality, things don't really work that way, because we set some level of a pricing like, hey, if I get this price, I'm kind of good with it. And yeah, there might be like 5 more people in the market who might pay you slightly more, but are you going to wait an extra month to get that $20? Because if you wait an extra month to get that $20, you're also losing the $980 that you were going to get at month 1. So what you don't want to do is you don't want to cut your nose off to spite your face. So that's what loss to lease means. The vacancy is basically a number built in over here. The reason why you see it's high, 8%, and then it slowly goes down to what we said is a sub-market average of 95%, is because as we are basically renovating units, we're jacking up the rents, we're doing all this work at the property. A lot of tenants, for economic and other reasons, will choose to move out of the property, right? They might say, look, I don't want to pay the higher rent, or I can't afford paying the higher rent. So therefore, at the start of when we're actually doing this work, we just have to assume a higher vacancy rate. Again, to be conservative, it might not happen. And then slowly over, say, 3 years, we come back to the sub-market average.
To the sub-market average, that's right.
Right.
And those vacancies give us our opportunity to do our value add turns.
Oh.
So that's, we want to see some of that vacancy. We've got to renovate those units. And if nobody moves out, then how are we going to execute our business plan? We're not throwing people out on the street. We're simply bringing their rents up to market, or maybe a little even above market if we really want them to move on their lease renewal. So that then they have the choice to take the lease at what we're offering to them and continue with an unrenovated unit at that price, or move someplace else, which opens up the unit for us to then renovate and bring it to that even higher mark. I don't know if you saw when he was showing you the rents, there was an unrenovated column and a renovated column. So there's the market rent, which is called there's a classic rent, which is your unrenovated, and then you have your renovated. So you're always going to have some in both categories, but we want to be, as our business plan is to move 70% of the units from classic to renovated during our ownership. And the only way that can happen is by turning, I think what do we have, 6 units per month is our goal right now.
6 units per month in the first year, but
In the first year.
we're probably going to push more than that. But that's just to begin with, right? Because
Right.
what happens is you ramp up slowly over a period of time, right? You
Right.
don't suddenly do things you were going to do in month 15 in month 1. Because
Right.
look, as an example, Lakewood Oaks is a good example, right? We could, for instance, renovate a lot of units, but if our exteriors don't match our interiors,
Yes.
we could renovate a lot of units. Nobody's going to pay us more money, because think about it. If you come into a property and it looks okay, it doesn't look the best in the world, your interior could be as nice as you want it to be, but nobody's going to pay you more money because the
That's
exterior
right.
doesn't match the interior. So you got to realize there's lots of stages and processes and things at the start. And so you just have to build a lot of slack into your system, be a lot of conservatism into your underwriting to ensure that, even with mistakes, you're not caught flat-footed.
Right. But your underwriting is your business plan. So in order, you do need to remember that you're there to execute a business plan, and you need to look back at your numbers, because you're trying to hit the numbers. Because if you're using other people's money, you were projecting that you said, I'm going to do this, and here's how I'm going to do it. You can always pivot, things happen, but you can't lose track of that underwriting. So that underwriting is not something you throw away after you buy the property and you're like, I'm done with this file, I don't need it anymore. No, you need it. You got to keep it.
And it also, and just to add to that point, a lot of times it also helps to calibrate you, right? Because what happens is we get so caught up in the day-to-day actions that a lot of times when we need to take a step back and say, okay, well, what did I actually want to do before I got sucked into all of these things?
The
right?
minutia.
Yeah, and the minutia of things, because it does happen. It also provides that context, right? Look, what was my business plan? Where am I going? And if I'm not going in the right direction, how do I pivot back to that place?
Right.
So
right.
it gives you that perspective.
We do like to do that after we've got 12 months of data, is take it and go back to the original underwriting and compare it and say, here's where I am, here's where I thought I'd be, and then learn from those trends that we're seeing. And you're learning from the specific metrics like bad debt or, concessions and vacancy. How did my assumptions compare to the actuals? And what direction does that mean we're going right now? And how do I need to pivot to address that?
Mm-hmm.
So
the other thing over here that you will see is that bad debt is somewhat lower than, say, the C-class properties.
Much lower.
But again, that's a testament to the type of tenants we have, the type of submarket we're in. Because look, you guys have to realize at the end of the day, bad debt is often directly correlated with the amount of income or not income people have. So think about it this way. You or I could come in and put in like granite countertops and granite everything. But if we're doing it in the hood and nobody can afford paying us, that's just throwing money away. Then you really can't blame the tenants, because a sponsor came and over-engineered the problem. So you have to realize that a lot of these metrics are not metrics that you can just take and apply to any property. Yeah. These are very
market and micro neighborhood
very
specific.
Market and product driven, metrics. And then, the property management fees, how we were saying it was about 6%. Well, we are at 3.5%. So that just shows you right off the top how much meat on the bone on the property management alone we just had. Mm-hmm. Right? So that gives you some context around the numbers.
Adding to what Omar was saying about, basically knowing what improvements to do depending on the property and the market. If you're, like he was saying, putting granite counters on a lower income area where people have to decide, do I pay this much for this unit, or do I pay for food on the table? That's going to be an easy answer for them. So it has to be very very specific on your plan based on the property and the location and the demographics that you're working with.
It has to match. There has to be a match. And that's, again, goes back to the median household income, right? Remember that?
Yeah, that kind of captures a lot of points right there. So big picture wise, what else should we look at?
Do we have any question here regarding? Yep, we got a question from KJ.
Yes, please.
If you could talk a little bit about the taxes, Omar.
I can just show you the taxes, actually.
The property taxes?
Yeah. Or yes, I can just show you the property
taxes.
I can just show you the property taxes. So what happened in Fayetteville is that, again, this is somewhat specific to...
so the question
Yeah.
Omar, just to clarify, the question that he's asking is on the taxes, because his understanding is that once you perform the improvements on the property, then the property is going to be assessed for a higher value, so your taxes would be affected by it. So how do you approach the taxes?
No, my friend, it doesn't really work like that in every county.
Yeah,
So
I was going to say it's very depending on the location.
The county.
The county.
Yes,
Yeah.
depending on the county.
So just first of all, just to give you an idea, Fayette County, where this is Fayette County assesses the tax they're going to charge every 3 years.
Yeah.
Some property do it every year. Some counties do it every year. Some counties do it
on transactional sale. Sometimes,
Yeah, there's a million ways to do it. Like, for instance, as an example, now you would think, well, if you buy a property for X value, then it should really be X value multiplied by the tax rate to give you, like, say, the dollar in tax and all. Well, that's not the way it works over here and in a lot of counties, because what you do is the purchase price multiplied by like a percentage, which is a percentage off the purchase price. In this case, it's 40%. Then you have the millage rate or the tax rate, which is 3.12%. Now, if you were to just look at this tax rate and you were to compare it to, say, the taxes, say, as an example, in Texas, in Dallas, that would be 2.2%. You'd be like, wow, Georgia has way higher property taxes. Well, that's not really the case. Georgia has lower property taxes because the percentage assessment of property purchase price times the appraised to purchase price percentage is way lower. It's 40% here. Whereas in Dallas,
80 or something like that.
In Dallas, in Tarrant County, it's coming to 95 or even 98 or even 100% these days. In Harris County, in Houston, it's right about 100% right now. In Bexar County, in San Antonio, they're increasing it a lot. So you have to realize it's not just the millage rate, which is the tax rate. It is how much of the purchase price are you assessing that against? So there's lots of moving parts. And then the other moving part in this particular case is that Fayette County assesses their taxes every 3 years.
Mm-hmm.
So some counties do it every year. So you understand there's lots of moving parts. And that's why a lot of times it pays to actually have a local tax, talk to a local tax consultant. They'll give you an idea, they'll provide you a guidance, and then you go from there. And look, at the end of the day, to be honest with you, every self-respecting property owner in the US should be protesting their taxes, right? So we protest our taxes as well across all properties. Now, in some cases, it might not work. In some cases, it does work. In most cases, it does work, right? But what you got to realize is if you don't protest your taxes, what happens in the future is then next year, the tax assessor, that's where they start from. So every year your base keeps going up, right?
Yep.
So you got to realize whether you win or you lose, you've got to protest your taxes.
Yeah, guys, and you got to be, like we said on the last, on our last meetup, for you guys that were here, it pays a lot if you decide to focus in one specific market or 1, 2, or 3 cities, whatever you choose. But then you can dive very deep into it, and you get to know how they calculate their taxes. You get to call the county, find out what the tax assessor, what process do they use to calculate taxes, property management costs and payroll, all those things. You can get to learn what is typical for that particular property or property location. Those are the benefits that Omar and Anna have been able to obtain during these years, and get into a property in this location with such great characteristics, and deep dive into it and get it working.
So are there any other questions? I'm sure there are.
Yes, Patrick. Okay. So the question is why the property management cost changed so abruptly from 6% to 3.5%, and the reason, being the same one. The reason was that this was being, correct me here, guys, if I'm wrong, but it was the same owner's entity. It had its own property management company, so basically they were charging themselves a specific amount, a higher amount.
Yeah,
just basically goes to their same pockets, just a different pocket, but their same.
My friend, when you're a rich guy and when you're rich people and you've got multiple pockets, these are the accounting games you have to play with yourself.
But in reality,
but
it would
we
be
weren't going to pay
equivalent
them
of
6%.
I mean, we weren't going to pay them, and rightly so. They never even negotiated from 6%, right? It was understood that this is an accounting trick. That's it. I mean,
Yeah,
they knew it. They didn't even fight it. They were like, "Yeah, we know this." So, but look, you have to realize, if you don't know these things, most people would start at 6% and maybe settle at 5%, right? Because you think you got to win. But if you know this and you're like, "Yeah, okay, Andy, I know this was like a accounting thing, but really here's what the market is paying." He's like, "Yeah, here you go."
Yeah, but they did try 6%. Their first thing, the first pitch
I mean,
they put in was
look, they're gonna try. Obviously, you can't blame them for trying.
come on, no. So you do need to know your market.
Answer your question. All right. Any other question, guys? This is an exceptionally quiet group for the first time ever. Never been so quiet.
The projected price. So how confident are you in the projected price for the sales price?
Oh, the expected sales price. How confident or how do you get to the estimated sales price?
Guys, how we get to the estimated sales price is that we take the NOI in the last year and we divide it by a cap rate, and we've artificially inflated the cap rate to more than what so for instance, let's put it this way. We think that the market is going to be less bad than what we have projected. We have projected a way worse market than when we bought the property. So do we know the exact sale price? No. But because we baked a lot of conservatism into our number, so we're estimating on the low end what the sale price is going to be, as opposed to estimating on the high end.
Can you throw up your spreadsheet again and show them your exit cap rate? Because it is very important for underwriting. Exit cap rate is a critical thing. So it's at the bottom of, well, there it is right there. Okay. So just to show them, what happens if you
5.6.
Yeah, it's 5.6. And what did we buy it at, Omar?
So we bought it at 5%, basically.
5%. Okay. And so it's a 5-year hold, and so we're projecting it's going to be 5.6.
Yeah.
So what happens if we were extremely bullish and foolish, and we thought that it was going to be 5.2 exit cap rate?
Here you go. So first of all, just remember, 33.171 million.
Save it off to the side. Copy that off to the side.
Oh, hold on.
I don't want to see your password.
That's not my password. This is, I don't know what happened. Oh, jeez. Okay,
so that's at 5.6. Okay. Now, if he changes this exit cap rate by going lower, so if he says it's going to be a lower cap rate, instead we bought it at 5 and we think it's going to be 5.2 at exit, look at what that does. Yeah. So then and then if you scoot down and look at your returns, your returns are not being impacted by that?
No, they are, right? The IRR goes up 18.6.
Oh, your
the equity multiple is 2.14.
Yes. Okay. So those ones went up. The 8.5% didn't go up. Yeah. So notice that so that is something you have to be very careful about in underwriting.
No, but your average cash on cash would not go up. It's just
of course. Yeah. Your average cash on cash wouldn't go up. But you need to be very careful when you're analyzing deals, even to invest in for yourself, that they're not doing something funny with the exit cap rate.
Yeah, it's a big contributor, and it hits the number really hard, either up or down. It could make a big swing.
Or think about it this way: if we just bought it at 5% and sold it at 5%, we would be at 36.984, which is really the difference is $3.8 million. Now, I don't know how rich you guys are, but 3.8 is a lot of money to me.
Yep. Does that answer your question? Yep. Okay. Any other question, Patrick? Yeah.
I heard bridge loan.
Do you hear the question?
No, I just heard bridge loan.
All right. So with the scenario that you have with the bridge loan in place, and having the options or decision point later on, either refinance into a permanent loan or or what is was? Oh, okay. So so in the case of what he's saying, on the case of refinance, a lot of times the management group takes the LP and pays them either partially or completely, or pay them off their investors.
You don't, no, hold on. You don't pay them off. What happens is, no, that doesn't work like that, man. Unless you're running the world's biggest scam, it doesn't work like that. You don't pay them off. What you pay off is, what you return to them is their equity. They still have the initial, share in the deal.
Correct.
Yeah,
correct.
They still have the same share in the deal where they started off. So it's not like you buy them out and they're like sayonara, right? It doesn't work like that.
No, correct.
Yeah.
Is that their initial investment?
Yeah.
Correct. But yeah, how would that work out with? Is that possible with this strategy with the bridge loan that you're putting?
Yeah, that's the entire reason why this is happening. Because with an agency loan, you really don't have a lot of options. Because look, it's nothing wrong about the agency. You've got to realize this. That is a different type of product. Yeah, it's a different business plan. It's a different product, right? It's a bit like if you want to haul, I don't know, a ton of lumber, you don't get a Ferrari just because it's a more expensive car. You still get a truck. But if you want to go really fast, you get a Ferrari. It's that sort of thing. It's different horses for different courses.
I think the question may be, guessing because I couldn't hear it, but did we do a refinance? And Omar is opposed. He's adamantly opposed to including refinances in the underwriting because it can falsely boost your returns. It definitely boosts your IRR. Because you're giving money back earlier to the investor. So your IRR gets jacked up and looks extremely good. So Omar is not in the camp of doing that. Will we refinance? Yeah, potentially we'll refinance. Then the investors' returns would only get better. But that's not the game we play in with Omar's underwriting for our projects. And it's not a game for every project. I don't want to say anytime a project has a refinance, it's a game. It's not. Because we refinance all the time, especially with new construction. When you're building new construction, you go vertical, you finish building, you have a construction loan that you're building with. Well, you have to refinance out of that construction loan to go into perm loan because a construction loan is a recourse loan. So you don't want to have that recourse loan. So again, it's different reasons that you might want to do.
Yeah, but it's a different kind of business plan.
It's a very different type of business plan.
Yeah, it's just two different things.
Omar, for this project, it is not baked in. Sure? There's no refinance baked in to this project, and you will not see it baked in any value adds for Omar.
Yeah, and look, guys, I'm going to be honest with you. I can bake it in. You'll think I look like a genius, but that's just
it's being conservative.
Yeah. It's you just pull a number out of your ass. Again, asinine ass. You just pull a number out of your ass, and you look nice starting out. But my point is, why make a promise you have no control over? Why make a commitment you have no control over?
Yeah,
right? That's what it boils down to.
All right. Any other question? Sure. Anyone? I think we're good. Oh.
Do you have a rule of thumb for your exit cap rate, or how do you determine more or less the exit cap rate?
I don't really. I mean, I think it's market dependent, product dependent, right? If you have a C-class property, 1970s build, you might go like 75 to 100 basis points higher. But again, it also depends what cap rate you're buying at, what the market cap rate is, what the business plan is, what market you're in. Look, if you're on Fifth Avenue, New York, that's kind of a different ballgame than if you're in St. Louis, Missouri. Yeah. Right? I mean.
So you always want it to increase. The question is, how much are you increasing per year? Between your entry and your exit, how much basis points are you going to go up? And I think that's what he's addressing, is it really depends on the asset class as well as the market that you're in.
Again, guys, this boils down to being in the market, looking at deals, seeing what other people are doing. How are, say, other smarter, sophisticated sponsors handling this? Do you agree with their assumption or not, right? Because sometimes people can make an assumption you don't agree with. Well, if you don't agree with that assumption, what are the reasons? If you agree with it, well, you know what the reasons are. So this comes from experience. There is no magic formula, right, where you type it into a calculator and you get an answer. So a lot of this is being in the market, knowing your particular market, knowing your particular sub-market, talking with other people who do similar businesses in that market, understanding and learning from them, because you're continuously learning, right? There's no like, you stop and you know everything and that's it. You're living in a vacuum somewhere.
Any other question? Any not related to this property, but any general question that you might have for Anna or Omar? It's the time, guys. It's not usual that we get, pick the brain on these people. Yes, quick. The question is there a minimum amount of money to invest with you guys?
Typically, it's $75K per project.
Do you have to be accredited?
It depends on the project. It depends on the project. Our project in Jacksonville, which was in February, was non-accredited, but this last project was accredited. I would say for Grow Capitus, 9.5 out of 10 projects are going to be accredited now, because we love using social media to advertise, and you can only advertise if you are doing accredited only. There's a lot of power that we get from the ability to advertise. And if any of you are on our social media, you might notice that we're been teasing you guys about a deal that's coming out next week. So we couldn't do that if it was for sophisticated or non-accredited 506B.
Yeah, and guys, both Anna and Omar are on Facebook platforms as well, Grow Capitus and Boardwalk Wealth as well, and Multifamily U as well. So, and they provide also tons of information, podcasts, videos, a lot of knowledge for free. So take advantage of that. And
can I mention, since you guys are in San Antonio, that we do have a boot camp coming up in Atlanta in March, in the first week in March. So if anyone wants to come to our 3-day amazing boot camp with Neil Bawa teaches, and I teach the underwriting, that's coming kind of halfway closer to you. Normally it's in California, but it will be in Atlanta, and it does include bus tour. So there's a good chance you can go see this property and see the work that we're doing on that property. So you'll see the renovations that are in progress.
Nice. Where can people get information about that, Anna?
Multifamilyu.com /bootcamp. And right now there's a extra early bird special that gets you $1,000 off. So I think that special is good for about 2 more weeks. And the page itself has lots and lots of information about what the content of the course, as well as testimonials and videos, and lots of information there to find out more about it.
Awesome. And Omar, website, where can people take a look at videos and material that you post?
So you can go to our website. It's Boardwalk Wealth, BOARD Walk Wealth, one word. Right on the front page, fill out your name. Hopefully you know that. Fill out your email address and fill out where you heard about us. Click on the button. It'll send you an email, verify your email address, and then you'll be added to our mailing list. But what you can also do is go to YouTube, type Boardwalk Wealth. That's 2 words right there. And you'll go to our YouTube's channel. I think it's called a channel, right? Click on the subscribe button. It's a little bell. Click on the subscribe button. You'll see all the videos. And especially for the last 2 projects, we started doing this. For the Lakewood Oaks project in Jacksonville, if you click on the playlist, you'll be able to see how, when we bought the property, where it was, and over the months, they're all like 2 or 3 minute videos. But what you'll be able to see is how has the property progressed from when we bought it to how it is right now. And we keep updating that, because that actually gives you an idea, because it's really hard to lie on video, right? You can't lie on video, but that gives you an idea. You start off at a certain spot, and over the course of the month, so you better watch it chronologically. Over the course of the months, you update this thing. Oh, what does that do? You update this thing. What does that do? And that provides a lot of context. That actually makes you understand, because till you don't see it, it doesn't really click that way till you don't actually see it happening. Yeah,
true value add. I mean, you can really see it happening at Lakewood Oaks. They were pretty tired looking, great bones, but really they were pretty tired looking buildings. And now it's all been rebranded. They're all painted. The interiors are being turned. Lots of things have happened in that community to make it a much better place to live.
Awesome. Thank you, guys. We cannot thank you enough for your time. Appreciate every single minute of it and information you provided. Any other question? No? Well, thank you, guys. You can. Thank you guys for joining us. And you guys have a good night. Appreciate it.
Thank you so much. Really appreciate it.
Thanks, guys.
Thank you, Anna.
Bye-bye.
Have a good night.
Thanks, Omar.
Bye.
See you tomorrow.
Bye.